And you really need to understand when you're underwriting for payroll and for insurance and for expenses, don't go light. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we are going to be discussing the 3 biggest challenges facing multifamily real estate today. Well, actually, I lied a little bit. Not 3. I'm going to add an extra 2 to make it 5 big challenges. And this may sound sort of depressing to you listening to this going, oh, wow, challenges. Are there any opportunities? Well, as we look at these challenges, let's look at the opportunities that these challenges present. Because if you just peel that onion back a little bit, there's a lot of problems we have in life. But if you dive deep into these problems, opportunities will abound. So let's get to the first one. And the first one to me is if you're operating multifamily or any business for that matter, coming out of COVID, it's been really challenging trying to staff, trying to get property managers, trying to get maintenance techs, trying to get people to work. It's very difficult. Higher costs, the costs of insurance, the costs of taxes, the costs of operations. That's been really challenging for those of us who have been in real estate and multifamily. I think in any niche of real estate, but even the overall economy. Now, I think it was worse a couple of years ago. People were staying home, they were getting checks. It was very hard to get people to come to work actually. But now that things have started to stabilize, there's still a challenge out there. And you really need to understand when you're underwriting for payroll and for insurance and for expenses, don't go light. Make sure that you understand what the expenses are in your specific market. That's challenge number 1. Now, challenge number 2, which to me has been a real challenge for us, at least since the pandemic, and 2021 and 2022 were challenging for us. There was, for us, less real deal flow. Now, 2023 for us, the floodgates opened, and in 2024, we at this point right now are going to be closing on our 4th deal this year. We have accumulated a little over 150 units this year. We will be by the end of this year, calendar year 2024. There have been a lot of less deals, and that's challenging because what happens is we get bored. Now, thankfully for Jake and myself in 2021 and 2022, when those years are lean, we decided just to stick with it. We had operational issues. Let's focus on our operations. Let's focus on the education company. Let's focus on the brand. And when the deals come, they come. What we could have done is we could have pivoted and said, hey, RV parks are doing great now. Let's get into that. But if we want to become the Chick-fil-A of apartments and we want to deliver superior customer service, how do we do that if we jump from one venture to the next? I've seen a lot of our members, a lot of students, a lot of people in multifamily just leave the business because they get bored. That's a challenge right now, but there's a silver lining because we do see deal flow coming back. And remember I said the problem, there's not a lot of deal flow? Well, what's the opportunity? For me, the opportunity now is that brokers are willing to talk to me because they don't have a lot of deal flow. They need to build back their book of business. They need to find more buyers and more sellers out there. So although there's a lot less deal flow, listen, multifamily peaked in 2022. We're down about 20% and prices are still continuing to drop, which is a great thing. That's the opportunity. With less deal flow, you're gonna have prices, they're starting to stabilize and come down. Buyers are not willing to overpay like they were. That's the opportunity. And with less deal flow, the opportunity is that we can actually talk to brokers. We have time to actually talk to investors because there are 2 things that we need to be doing in multifamily. Never forget this, or in my opinion, in the business of real estate. Always look for deals and always source capital. Do you need the deal first or you need the capital? Well, if you're doing a deal by yourself and you have the capital, that question is answered. But sooner or later, you will run out of capital. That's why you need to be doing both at the same time. And there's the opportunity. Start looking for capital as well. Now, the third one is the pullback in available capital. What's happened over the last couple of years? A lot of limited partners have gotten burned. They're sitting around the proverbial water cooler and saying to themselves, oh, this syndicator is not paying me. I'm getting a capital call. I'm getting foreclosed on. There's a little bit of fear. If they're in a deal, are they going to go into another deal? Probably not. And not only the pullback in available capital from passive investors, also from banks themselves. They want more down payments. The loan to values are dropping. They're being much more stringent on giving capital out. There's an opportunity for you. All of a sudden, what's the opportunity? Seller financing. That hasn't worked in the past 7 or 8 years. Jake and I busted onto the scene in 2013. Our first deal was a 25 unit seller carryback at 10%. Our sixth deal, an $11 million seller finance, 20% carryback note on that bad boy. It was awesome. And then 2016, 2017, seller financing started to disappear. Now it's back. We've actually done a deal with seller financing back in 2023. We had another one under contract. It fell out because of the due diligence, but we had $1 million seller financing on that deal as well. Now, if you want to learn seller financing, email me, gino@jakeandgino.com, and I'll send you a copy of our Creative Cash. Listen, we launched it back in 2021. We knew it was on the horizon. It's one of those tools in the tool belt that will help you as debt is pulling back. You can use this tool. The other one is debt's pulling back. The opportunity is start getting more investors, start bringing more capital to the table. And the other opportunity that I see is there are going to be less competition, less people being able to do deals because they can't either raise capital or banks aren't going to be serious with them. They're going to say, you know what, you're not qualified. So if you're out there and you're qualified, there's the opportunity. Now, let's say 3.1. I said 3, I'm going to give you 2 more. And this one is crucial because I think this is where the problem started in 2021 and 2022. Let me say this slowly because this is important. So we will not repeat this mistake in the future. If you're buying a deal that is stabilized on bridge debt, that's probably not a good idea. We were looking at deals that were stabilized. Rents were $800 to $900 with the possibility of going to $1,100 or $1,200 down the road. And people were using bridge debt to finance these deals. Now, if you've got a sound business plan, you're an experienced operator, you can move, that may work. But for the vast majority, it didn't work because COVID got in the way. Remember, number one, you couldn't hire, number one. Number two, materials weren't around. Business plans were elongated, and now that's the problem right now. The debt is maturing. I think a third of all loans right now have floating rate debt. And by the year 2028, almost $3 trillion of commercial debt is going to be coming due. Big problem for a lot of us out there. The opportunity is go out and find which ones are having problems. Go out and try to solve those. So be careful with floating rate debt. If you've never used it, it's a great tool if you know how to use it. We always say buy right, manage right, and finance right. In this part of the market cycle, Jake and I have been very successful using credit unions with 5-year terms. So we have at least 5-year runway to be able to hit our business plan. And guess what? Rates right now are at 6 3/4. They will be going down in the next 24 months. When they do go down and our properties are stabilized, we'll be able to refinance them out and bring them to agency. But if they don't, we're okay for the next 4.5 years because we have stable fixed rate financing. And this last one, number 5, there's an oversupply of assets. The number of permits peaked for multifamily back in, I think, mid-2023, and they've taken a really big descent, really big fall, because what happened in 2023? Rates started going up. It didn't make sense to start permitting these properties. They're on the shelf. And all of a sudden, this massive building, this massive boom that had been going on had started in 2020 and 2021. All these assets are starting to come to fruition. Remember, once again, I just talked about the supply chain issues and all. Well, these projects got pushed out. And guess what? In these markets like Nashville, like Charlotte, like Phoenix, even New York City, don't quote me, but I think New York City's got 30,000 units coming online. It's insane what they have coming online. Now, that's a problem because in the short term, guess what? Rents are going to drop, or at least they're going to be concessions. And I think people in those higher asset classes can drop down into the Bs. So there's going to be some price competition. Gone are the days of 20% rent growth. They're not going to be there for the next year, 2 years. But guess what? That's a problem. But where's the opportunity? The opportunity is, if you're buying these kinds of assets, go and see from these builders that are out there buying these assets. They're starting to lease them up. You can buy them at a discount because they're not fully leased. They're giving concessions, and there's the opportunity. And the opportunity also is if you can buy them on actuals when all of this, building becomes absorbed, and it will in the next 6 to 12 months, because these markets that have this building going on, guess what? They've got a lot of population growth, and they do have the job growth. So in the short term, it's going to be a hit. But in the longer term, if you're buying these assets correctly at in-place interest rates, and like I said, rates drop, well, all of a sudden, you're going to be looking like a genius. I know it's a little scary right now. I know people are saying, I'm on the sidelines. I'm not getting into multifamily until things crash, and I'm going to try to buy things at the bottom. Well, guess what? We know where the high is because we can look back and say 2022 was the high. Prices are down 20%. Are things going to go lower? I'm not sure. I'm almost certain that when rates do drop, there's going to be more money coming into the market. Prices will start going up again. That's just a function of interest rate and market rate cycles. I don't know when the low is, but if you look at all of these problems or all of these challenges that I've just listed, see where you can find the opportunities in these problems. I don't want you to wait on the sidelines. I want you to buy real estate and then wait. It's a long-term game. This is only one little part of the market cycle. I'm going to leave you with this question. And I want you to really ponder this, because this is how I got started, because I was always making excuses. I look back 5 years from now, back in 2019, and I say to myself, should I have bought real estate back in 2019? The answer is, I should have. Now look today, you're in 2024. Project yourself out 5 years from now. It's 2029. Should you have started to buy real estate in 2024, depending on where the prices are or whatever? Are you going to be okay 5 years from now? I think most of us would answer yes. I started back in 2011 with Jake. Everyone thought I was crazy. Real estate's risky. How many of us wish we had the foresight and the opportunity to go back then and buy assets at those prices? Well, that's where we're going towards right now. It seems as if we're entering a recession. It seems as if things have been slow for a little while. That's been more challenging. Expenses up, not as much deal flow. I want you to find the opportunities in those. I want you to stop making excuses. If you're serious about your financial future, you will start today. And I will end with my slogan that I truly believe in my heart of hearts, is that people with financial intelligence can change the world for the better. That's what I want you to do with multifamily. Use it as a tool and as a vehicle to impact others. I want to thank you for listening to this how-to lesson. Thanks for taking part of your day out. I hope I've added value to your life, and I'm looking forward to seeing you on next week's how-to. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.